A little bit about us. And my name is Rachel Gustafson. I'm joined by Brittany Jacobson. We're going to be guiding you through our webinar today. Hopefully you're all sitting somewhere comfortable with a nice cup of coffee or tea, or maybe you're having an early lunch and you're ready for some financial learning. So a little bit about who we are. We are a financial investment team. We're a woman-owned and run firm, and we specialize in holistic financial planning and financial education. So Brittany and myself are certified financial planners, which if you aren't familiar with the designation, we went through extensive training and experience requirements, and we committed to the CFP board's ethical standards that require us to put our clients' interests first. So normally we offer in-person seminars, but we've moved our offerings to a webinar-based approach so that we can meet you in your homes where a lot of us are spending time right now. So we're excited to have you here with us during your lunch hour. All right, 6 retirement account options every retiree must know. So today we're going to talk about what's likely to be one of the most important retirement decisions you'll ever make. What should you do with your retirement money? Like a 401k, 403b, or a similar plan once you leave your job. Maybe you've recently been laid off, or you've taken a severance package. Maybe you're just considering early retirement, or what you need to know and what your options are. Depending on your particular situation, you may have up to 6 different options to choose from. So today we're going to talk about each of those 6 options so that you can make the best decision for yourself and your family. Before we jump in, I'm going to start with a question. It's going to pop up on your screen. Let me just set it up here. What is your biggest fear in preparing for retirement? This just gives us an idea of everyone who's in the room, but the most common that we see are potentially running out of money, a healthcare crisis, or Social Security running out. So if you'll just take a moment to answer that. Running out of money. This is very, very common. Looks like 100% of us are worried about that. Regardless of which fear you most related to, having a plan can help you give you peace of mind. So today we're going to educate you on your options. Hopefully you'll come away with the education you need to make an informed decision about your retirement funds, but also encourage you to start building a plan if you haven't already. So following today's webinar, we're going to be offering complimentary check-ins where you can ask us questions about your personal situation and your plan. So please do take advantage of that. All right, so we have 6 potential rollover options for your plan funds. And we're going to go into a little more detail on each of these. The first is leaving your employer plan assets in your existing company retirement account. So leave them where they're at. You could roll over your plan assets to a new company plan if you have a new employer, if the plan allows. You could roll over your plan assets to an IRA, take a lump sum distribution of your plan balance, convert your plan assets to a Roth IRA, or make an in-plan Roth conversion of your plan assets. So we're going to look at each of these in greater detail. Option number 1, so leaving the funds in your company retirement plan. This is the most straightforward of all the possibilities. You can just leave it, choose to do nothing. You're essentially choosing this option. Of course, there are a number of reasons why you might intentionally leave your money at your plan too. Most of you will have this option available to you. There are a few times when a plan will force you to take a distribution, but for the most part, this is an option that you have and that I see pretty often. Especially if you're switching jobs, you have a lot going on. It's an easy thing to just say to yourself, I'm just going to leave it where it's at for now. So why might you do this on purpose? If you're lucky enough to be retiring early, or if you've otherwise left your former employer in the year you turn 55 or later, you can take a penalty-free distribution from the plan sponsored by the company you just left. This is different than the general rule, which says that you have to wait until you're 59 and a half to take a penalty-free distribution. Once you're 59 and a half, there is no longer any concern. But there is this exception in employer plans where you can potentially take funds after you've separated from service at age 55 or later and avoid that 10% penalty that you would normally see. Similarly, certain federal, state, and local public safety workers can take a penalty-free distribution from their plan at age 50 or later. And so you would just need to check with your plan to see if this is available to you. Another reason is creditor protection. So if this is a significant concern for you, it may make sense to leave your money in your plan. Certain plans, like most 401k plans, offer creditor protection under the Employee Retirement Income Security Act, the federal law known as ERISA for short. ERISA offers very strong creditor protection and safeguards covered funds from the reach of most creditors. On the other hand, IRAs, Roth IRAs, and plans that don't receive creditor protection under ERISA receive creditor protection under state law. Thankfully, most states provide these retirement funds with creditor protection, and it tends to be roughly equivalent to what is provided by ERISA, but that's not always the case. So you just need to check with your state to see what those options are and how much coverage you have. So you should always be aware of the fees that you're paying in your current plan and the difference in any of the fees that you would be paying if you move your retirement funds elsewhere. Fees really vary greatly from plan to plan. In some cases, your plan may offer certain investments at lower cost than you can get elsewhere. Of course, the opposite may also be true. A rollover to an IRA or other retirement account could help lower your fees. You simply have to look at these situations case by case. Of course, it's important to consider the value you're receiving in conjunction with the fees you're paying and not just the fees themselves. So if your funds are in your 401k right now and you're paying a fee for that, but you're not getting, for example, financial planning advice or help in preparing for retirement, it might make sense to switch the funds to a provider where you have an advisor and you have someone who's helping you with planning. Of course, no solution is going to be perfect all the time, and just leaving your money with your old employer is no exception. There are any number of reasons this might not make sense for you, some of which you can see here. Just a quick note, the CARES Act that was passed for this year doesn't require a 20% federal tax withholding as mentioned here, and that's just for the year 2020. But some things to consider: more appropriate investments may be available elsewhere. With a 401k, 403b employer plan, you have a set menu of what you get to choose from. You don't have a lot of flexibility. You might get better service elsewhere, like I had mentioned before. If you're interested in doing financial planning and working with an advisor who can really help you with your personal situation, it may make sense. Certain exceptions to the 10% early distribution penalty are only available in IRAs. Your plan may place certain restrictions on when you can take distributions of your funds. I had mentioned that 20% needs to be withheld for federal income taxes. Normally in 2020 with the CARES Act, it isn't required. Investments and other fees may be higher than other options, and estate planning can be more difficult than if you were able to move your funds to an IRA, for example, elsewhere where you can do a little more estate planning. So we've talked about why it might make sense to keep your money in your current plan, but many people do choose to move their plan money elsewhere after they leave their job, either to another plan or more commonly to an IRA. So before we talk about why that could make sense for you, let's talk about how to move retirement money. This can get confusing. In general, there are two ways you can move retirement money from your plan to another retirement account. So you can either move it in what we call an indirect rollover, or you can move it right from your plan to your new retirement account in what's known as a direct rollover. A direct rollover is generally the best way to move your money. So let's talk about why that is. In an indirect rollover, you receive a distribution of your plan funds payable to you, or they are sent to a non-retirement account, so maybe your savings account at your bank. And then from that point, you have 60 days from the time you receive your distribution to get it back into another retirement account. Now, 60 days may sound like a long time, but it can go by very quickly. Let's face it, life happens, we get distracted, we get busy, we get sick. If that happens and you miss that 60-day deadline, the distribution is taxable. And depending on your age, it may also be subject to a 10% penalty. So even if you're on top of things and you complete your rollover within the 60-day window, there's another problem with most indirect rollovers. So when Congress created the plan distribution rules, they wanted to make sure that people didn't take their money out and run. So they created a special rule that requires plans to withhold 20% of taxable distributions that are payable to you when those distributions are eligible for a rollover. So for example, let's say you have $100,000 in your plan and you request a distribution for the entire amount. Your plan is actually going to send you a check for $80,000. It's going to withhold $20,000 of your balance for federal income taxes as a just in case you don't actually put those funds into a retirement account. Now, suppose you take the $80,000 and you're very timely, you get it into the new IRA that you're going to put it into. Have you completed a full rollover of your plan distribution? You had $100,000, you're depositing $80,000, $20,000 was withheld with your plan. No, even though you only received that $80,000, that's all you put in, but technically to make it a full rollover, you need to put $100,000 into that account. If you want to complete a full rollover and avoid any taxes on your distribution, you're going to have to roll over that $80,000 and make up the $20,000 that was withheld from other savings. So what do you do if you don't have $20,000 just lying around? Well, that's just too bad. And just imagine if your distribution is larger, say $500,000. In that case, in order to complete a full rollover, you would have to come up with a whopping $100,000 to make up the amount withheld for income tax. So just really, really important to understand that when you take an indirect rollover and taxes are withheld, you're in charge of making up that amount and making sure the whole rollover gets deposited if you don't want to have a tax impact. And again, I had mentioned this about the CARES Act. Plans are not required to withhold that 20% in the year 2020 as of right now. So it doesn't apply this year, but on a normal basis, they are required to withhold that 20% for indirect rollovers. So there can be some real problems with indirect rollovers. I've had clients who have sat in my office and said, I didn't get that check in time. And then we had to do some intense planning to rectify it. Unfortunately, once you're past that 60 days, there's no way to go back. So just be aware of that. Thankfully, there's generally a better way to move your retirement money, and that's the direct rollover. In a direct rollover, your plan money is sent right from your plan to your new retirement account. Most importantly, there is no 60-day time limit to worry about, and there's no mandatory 20% withholding. So a direct rollover is what we usually recommend our clients to do. Sometimes, though, a plan won't offer to send your money right to a new retirement account. And in fact, I see this fairly often, where you call to request the rollover and they'll only mail it to you. They will, however, let you designate it as a direct rollover. Typically, this is done by providing you with a check that's made payable to your new custodian. So for example, the check might read, Financial Investment Team, custodian for the benefit of John Smith IRA. If the check is made payable to your new custodian, your distribution can still qualify as a direct rollover and get the same favorable tax treatment. There is no 60-day deadline, no mandatory withholding. That's true even if your plan mails you the check and has you forward it to your new custodian. All right. Now we know that we understand the differences between indirect rollover and direct rollover. Before we go back to exploring your rollover options, we're going to answer another poll question. How long do you have to deposit indirect rollover funds if you do an indirect rollover? So I'm going to pop this up for you and just take a quick second to answer. Good, it looks like most of us. I hammered that home, 60 days. All right, moving on, let's see here. Option number 2, roll your money to a new company retirement plan. So if you go back to work for a new employer that also offers a retirement plan, you might be able to roll your old plan funds into your new plan. So note that plans don't have to allow this, so it's something that you need to check with your new employer to see if this is an option. The reasons to roll your money to a new employer plan are generally the same reasons you might consider leaving money in your old plan, such as the potential for stronger creditor protection, possibility of purchasing life insurance with plan funds, possibility of lower fees. If this sounds like a lot of maybes, it is. When it comes to plans, the tax code is often far more liberal than a plan's own rules. So a lot, as mentioned before, varies from plan to plan. This is something that we do with our clients is I always request a copy of the plan document so that I can read through it and understand what type of plan you have and what allowances there are and what you can actually do for planning. Every plan is very different. So in addition to the benefits we discussed before, there are a few other reasons why you might roll your old plans into a new plan. So one reason is if you need to take a loan from your retirement money. So in some cases, you may be able to take a loan of up to $50,000 from your employer plan. In contrast, you cannot take a loan from an IRA. It's what's known as a prohibited transaction and comes with some scary tax consequences. In fact, if you had $1 million in an IRA and you borrowed just $1, your entire $1 million would be considered distributed and fully taxable to you. So it's not something that you can do in an IRA, but loans are something you can do in your employer plan. And most employer plans, you do have to reach out to them to see what your options are. Another change with the CARES Act for 2020 is you can borrow up to $100,000. So they doubled that $50,000. Another reason it might make sense is if you want to use your retirement money to purchase life insurance and your new plan allows for it. To be clear, this is where you purchase life insurance while your money is still inside your plan. Life insurance is a prohibited investment for IRAs, so you cannot roll life insurance over to an IRA. A more practical reason you may roll money from an old employer's plan into a new plan is simply to consolidate your accounts, and this is the most common. Many people, particularly as they get closer to retirement, you're trying to simplify and organize your lives. Rolling over money from an old plan to a new plan means one less account statement to keep track of, one less beneficiary form to keep up to date, one less account to make sure is appropriate, and that you've taken appropriate required minimum distributions once you get to that point. So consolidation can be something that you might be looking at. So there are potential limitations and risks of this option, which are up here on the screen, very similar to the last. More appropriate investments may be available through your old plan or after an IRA rollover. Better service may be available. Certain exceptions to that 10% early distribution penalty are only available in IRAs. They have their own rules. Your new plan may place more restrictions on when you can take distributions. There's that 20% of federal income taxes that's withheld. Investment fees may increase. Creditor protection may not be as strong, and then estate planning may be limited. So just really what we're coming to you with here is make sure that if you do elect to roll over funds from a previous employer to a new employer, that you understand the plan and how it will affect you. So this leads us into option number 3, rolling over to an IRA, the most common that we see. And this must be available to you. It tends to be the preferred option for many when they leave their employer for a variety of reasons. If you want, you can roll your funds over to an existing IRA if you already have one established, or if you don't already have an IRA, you can set up a new one and move your plans into a new IRA. The most common reason that people choose to roll over their plan funds to an IRA is to broaden their choice of investment options. Many plans restrict participants to a dozen or so choices that you have, and they tend to be mutual funds. You may have experienced this in your own plan. While the investments offered by your plan may be sufficient for your needs, many retirement savers prefer to expand their investment options by rolling over their funds to an IRA. Once inside an IRA, there are very few restrictions as to what you can invest in. In fact, while your particular custodian may be more limiting, the tax code allows IRAs to invest in anything except life insurance, collectibles, and S corporation stock. You have a lot more flexibility. You can have an investment plan that's really tailored to you and your retirement plan. Another common reason many retirees choose to roll their plan funds to an IRA is to consolidate their retirement savings. This is the most common that we see. A study released by the U.S. Department of Labor reported that baby boomers born between 57 and 64 held on average a staggering 11.3 jobs between the ages of 18 and 46. So sure, it's unlikely that you have 11 different employer plans, but you certainly could have participated in 2, 3, or more. An IRA can serve as a convenient collection point for these plans, leaving you with fewer accounts to keep track of and watch over. And this is probably what I would say is the most common, is consolidation into an IRA where you can have a customized plan and you can have a planner, financial planner that helps you customize it according to you and your retirement. IRAs oftentimes offer more attractive withdrawal options than plans. With an IRA, for instance, you can generally request a distribution whenever you want one. If you leave your money in your old company plan or roll it over to a new one, you're stuck with that plan's rules. So your company plan might be flexible, but it might not. Another big difference between company plans and IRAs on the withdrawal end is that there is no mandatory 20% withholding on IRA distributions. With IRAs, you can elect to withhold 10% of your distribution for federal taxes, any amount more than 10%, or if you want to, you can even opt out of federal withholding altogether and have none of your IRA distribution withheld and then just pay it at the very end of the year. So you have a little more flexibility. So here's some examples that we're going to look at. If you have more than one IRA, you can calculate your required minimum distribution. So your required minimum distribution at the age of 72, the IRS says for your pre-tax traditional IRAs, you need to start taking distributions. This is how Uncle Sam gets their taxes, right? And so if you have multiple accounts, what does that look like? If you have one account that you really like, that's earning a high rate of return, and you don't want to take your required minimum distribution from it, and you have another account that you're less happy with, you can actually take your entire required minimum distribution from one IRA. So if IRA number one has a required minimum distribution of $5,000, and we're looking at the example on the left, and IRA number two has a required minimum distribution of $3,000, and number three has a required minimum distribution of $2,000. So your total RMD is $10,000. You can aggregate that RMD and take it out of one of your IRAs. Now, with employer plans, you don't have the same flexibility. You actually have to take your required minimum distribution from each of the plans that is required. It's not okay to aggregate. So you have less flexibility in how you take your required minimum distributions, and that's what IRAs will do for you, is give you some more flexibility around that. Rolling over your plan funds to an IRA can also provide estate planning benefits, such as making it easier for beneficiaries after you're gone by consolidating accounts. On the other hand, in some cases, rolling your money to an IRA can be beneficial for the opposite reason. Doing so may allow you to split your account into multiple accounts, each left to a different beneficiary. That may be helpful in situations like the ones you see here. Some plans may not accept certain beneficiaries such as trusts. So if you've had a trust established and you want it to be a beneficiary, certain plans won't allow for that. They may also not allow you to use customized beneficiary forms or allow your beneficiaries to utilize certain strategies, such as disclaimer planning. Rolling your plan funds over to an IRA that allows for these options can resolve the issue. If you have more questions around specific estate planning, let us know in your appointment and we can go over what might make sense for you. So as you can see, there are a number of potential benefits of rolling your plan money over to an IRA. To review those benefits may include a broader array of investment options, more flexible distribution options, required minimum distribution aggregation across multiple IRAs, and more estate planning flexibility. So when it comes down to it, all of these things can really be summed up in one word, and that's control. In general, an IRA simply gives you more of it. But they're not perfect. As you can see here, there could be some downsides to making this move. Listed here, I went through this on some of the other slides, but more appropriate investments may be available. Better service may be available. Certain exceptions to the 10% early distribution penalty are only available for planned distributions. Certain lump sum distribution planning options may be eliminated. Investments or other fees may be higher, so on and so forth. Before we move on to option number 4, I'm going to introduce Brittany. She's going to be taking over from here.
Thanks, Rachel. Okay, so Rachel talked about the first 3 options you have available, leaving the funds in your current employer plan, moving them to another employer plan, and rolling over into an IRA. I'm going to start with option number 4, which is simply taking the money out of your plan. This is often referred to as cashing out the plan, and in general, it's considered not to be a really great idea, mainly because the distribution is added to your income for that year. And with most retirement plans, they are tax deferred, so you lose that tax deferral once you take a lump sum distribution. Despite compelling reasons like these to not take a lump sum distribution, a lot of people still choose this option. Now, I said it's generally not a good idea to cash out your plan, but that's not always the case. In fact, if you're lucky enough to have the right set of circumstances, cashing out your plan might make a lot of sense. And that's because there's a number of tax breaks, like the tax break for net unrealized appreciation, that can offer some big tax savings for you. Before we talk about these tax strategies, I first want to explain what a lump sum distribution is. The lump sum distribution from a company plan means that you take the entire balance in 1 year. Your account balance has to be 0 by the end of the year. You can't have anything left. If not, it's not considered a lump sum distribution, and then you can't utilize some of the special tax breaks. And this is a calendar year, not 365 days. And then your distribution also has to take place after what's known as a triggering event. So we're going to talk about that next. There are 4 triggering events outlined by the tax code. The first one is death, which really doesn't help you out very much, but could allow your plan beneficiaries to take advantage of the special tax breaks that we're going to talk about in a minute. The second is reaching age 59.5, which is generally considered the earliest age of retirement that you don't have to pay a 10% penalty. The third option is Separation from service, so you've retired, you've resigned, or otherwise left your employer. It's important to note here that this is not a triggering event for self-employed individuals. So you cannot, unfortunately, fire yourself in order to try and take advantage of this triggering event. However, self-employed individuals can use disability as a triggering event, but it's important to know that disability for this purpose is a lot more restrictive than disability for other purposes, so just keep that in mind when you're trying to use this as a triggering event. Okay, so now that we understand what a lump sum distribution is and what the triggering events are, we can talk about the strategies surrounding the tax breaks. We're going to start with net unrealized appreciation, since it's probably the most common and would potentially affect the most number of people. Sometimes company retirement plans, such as your 401k, will allow you to invest your retirement money in your employer's own stock. So you work for ABC Corporation, you have an ABC Corporation 401k, and you can invest in ABC Corporation stock. If you decide to make an investment in ABC stock, then any gain you earn on those shares while they're inside the plan is known as net unrealized appreciation, or NUA for short, and is eligible for the special tax break. So at its heart, the NUA strategy is a tax move that, for a portion of your retirement savings, you trade ordinary income tax brackets for long-term capital gains brackets. So given today's tax rates, this could be savings of up to 20% depending on your current bracket. So how exactly does net unrealized appreciation work? So there's really just 3 important rules that have to be followed. We've already talked about 2 of them. The first rule is that everything has to come out of your plan in 1 year. The second is that the distribution has to take place after a triggering event. And the final requirement is that the shares of your company stock have to be distributed into a taxable account, such as an individual account or a joint account. They cannot be rolled over into another retirement plan or an IRA. And that's because the point of this is to take the distribution, pay the taxes on it in 1 year, and then it goes into a general taxable account. If you were to roll it into another retirement plan or an IRA, you're not paying the taxes on it when you do that move. And so that's why then that unrealized appreciation won't work in that instance. So if you do that and you roll the funds over to another plan or an IRA, you lose that option. And that's actually a mistake that a lot of people make. Okay, so if your head's spinning a little bit, I don't blame you. Net unrealized appreciation is a pretty powerful strategy. And as you can see, it's a little bit complicated. You're probably not going to remember all of the rules that we've talked about, but it's important to just ask yourself these 2 questions, and that'll help you figure out whether this is a strategy for you. The first one, do you have stock of the company you work for inside your plan? If your answer is no, the net unrealized appreciation strategy is probably not something you have to worry about. The second, has the company stock that is inside your plan appreciated significantly since you purchased it? Again, if the answer is no, probably not a strategy you need to worry about. However, if you do have company stock in your plan and it has achieved a large gain, then you need to seriously consider this as part of your planning. And as part of that planning, I strongly urge you to consult with a tax and financial advisor with specialized knowledge in this area. It's really rare that the company stock is going to be the only asset in your plan. And so you need to consider how the potential savings on the long-term capital gains combined with taking the whole distribution and having to pay ordinary income on the remainder of the plan works into your overall financial plan. There are other special tax breaks available for lump sum distributions too, such as the 10-year averaging and pre-1974 capital gains elections. There's still lump sum distribution planning strategies. So again, everything out in 1 year, and you need to have a triggering event. I'm not going to spend a lot of time on these because they don't apply to all that many people anymore, but I do want to make sure you understand that they do exist and they could be available. The first one is if you were born before 1936, or if you had money in your retirement plan by December 31st of 1973, then these potential tax breaks could be applied to you. And so you want to talk to an advisor and see how you can take advantage of them. And of course, along with all the other strategies, there are some potential limitations and risks associated with this. The biggest one here is that all of the plan assets, the distribution, is added to your income in the year that you take the distribution. If that was before age 59 and a half, then there's a 10% penalty. And you lose the tax deferral option for those funds. Okay, so we're going to move on to option number 5, which is to convert your retirement plan assets to a Roth IRA. Well, it's certainly not going to be the best option for everyone. It's an option that everyone has available, and you need to consider it. In a Roth IRA conversion, funds go from your plan, you pay taxes on them, and then they go into a Roth IRA. Now, for those of you who aren't familiar, a Roth IRA is a tax-free investment account, meaning you pay taxes on the money before it goes into the plan, and as long as certain specifications have been met, then it grows tax-free forever. So, for example, let's say Jane has $100,000 in a traditional 401k, and she wants to convert the entire balance to a Roth IRA. If Jane moves forward with the Roth IRA conversion, then $100,000 is added to her taxable income for that year, and it's taxed at whatever rate that she happens to be at. And because it's a taxable event, you want to make sure that you talk to a tax advisor beforehand. Now, at some point, you've probably heard that you should never pay taxes before you have to. And that's a really traditional way of thinking, and a lot of cases it may hold true. But there are a number of reasons why you might consider a Roth conversion. First and foremost is the potential for tax-free distributions from the Roth IRA in the future. So if you're over 59 and a half and you have had any Roth IRA for more than 5 years, then all distributions from any of your Roth IRAs will be tax-free. If you're over 59 and a half, but you haven't held a Roth IRA for at least 5 years, then you can take out any of the converted amount at any time tax-free. And so we're going to talk about an example of how that works. So we have Jane. She's going to take that $100,000 from her traditional 401k, and she wanted to convert that to a Roth IRA when she's 60 years old. Now, this is going to be her first Roth IRA. Now, we're going to assume that by the time Jane is age 70, the Roth IRA is now worth $300,000. So she's had some pretty good gains. So if during the first 5 years after the conversion, so between age 60 and 65, Jane can only distribute up to that first $100,000 tax and penalty free. After the first 5 years have passed, all distributions, including the earnings, will be tax and penalty free. So she could take at age 66 the whole $300,000 and not have to pay any tax on any of it. The potential tax-free nature of the Roth IRA may also provide you with some additional benefits, such as a hedge against tax rates rising in the future. So when it comes to retirement, there's a lot of unknowns. What will the market do? What will inflation be like? What will your tax rate be? And so on. And taxes is a major concern for most retirees. A Roth IRA conversion can help manage that risk by paying taxes at today's known rates. And if tax rates rise in the future, the tax-free distributions that you can take from the Roth IRA will be even more valuable to you. Of course, if you think your tax rate might be lower in retirement, then that might be a really good indication that this strategy isn't right for you. Also, since Roth IRA distributions in retirement are generally tax-free, they typically don't impact other things tied to your income. So for example, tax-free municipal bond interest is generally added back to your income to calculate how much of your Social Security is going to be taxable. And that's not the case with a Roth IRA. They can also help you keep other costs tied to your income lower, such as your Medicare Part B premiums. Another big benefit of a Roth IRA, and one that a lot of retirees find the most attractive, is that Roth IRAs have no required minimum distributions during your lifetime. And the reason for that is Uncle Sam already got their tax money. They could care less what you do with it now. So during your retirement, you can take as much or as little as you want. You're not forced to take anything at 72 if you don't want to. This means that your Roth IRA can continue to grow and compound tax-free for your heirs. And it makes it a really intriguing vehicle for estate planning purposes. And then just a note, when it comes to your beneficiaries, a non-spouse beneficiary like your children, they will have RMDs from the inherited Roth IRA, but those are going to be generally tax-free as well. So just as with all of the other options, there are some limitations and risks to this one. The first one is just that the distribution is going to be taxable for whatever value you want. You can choose to do a Roth conversion for the whole account balance or a portion. It's up to you how you want to do it. Just keep in mind that that is taxable to you in the year you do it. And loans cannot be taken from a Roth IRA. Creditor protection might not be as strong. Life insurance can't be purchased. So a lot of the similar limitations and risks that you see with a rollover to an IRA. All right, so we've come to our sixth and final option, which is an in-plan Roth conversion. It's a relatively new option and might not be available to everyone, but I do want to make sure that you're aware of it just in case it applies to your particular situation. So it's very similar to a Roth IRA conversion in that you take the pre-tax money in your account, pay tax on it, and then you have it in an account growing potentially tax-free for future use in retirement. The difference here is that the conversion is made from the traditional side of your company plan to a Roth side of your company plan. So if you have the option that allows in-plan conversions, you're just moving funds from one sub-account within your plan to another. You're not moving the funds out of the plan. So why consider an in-plan Roth conversion? From a tax perspective, the impact on your tax return from a Roth IRA conversion and an in-plan Roth conversion are pretty much the same. There's not a lot of difference there. You have to add the amount you convert to your income for that year, and if you meet certain guidelines, future distributions in retirement are tax-free. So if you decide to make an in-plan Roth conversion after you retire, you're making two choices. First, you're deciding that the Roth conversion makes sense for your tax planning over the long term. We've already discussed a couple of the reasons why that might be. And secondly, you're deciding you're better off keeping the money in your employer plan than you are to moving it to a Roth IRA. So if both of these statements are not true, then one of the other 5 options we've already discussed is probably a better choice. There are also some distinct disadvantages of an in-plan Roth conversion compared to the Roth IRA conversion. The biggest drawback here is that when you do an in-plan Roth conversion, minimum distributions are generally still required once you reach age 72. And one of the major reasons why so many people consider a Roth conversion in the first place is to avoid the RMDs and to allow the money to compound tax-free throughout their lifetime. So that's generally not going to be the case with an in-plan Roth conversion, though. They still want you to take the money out of the account every year starting at age 72. So if avoiding RMDs are important, then you would want to do a Roth IRA conversion instead. Okay, and I promise this is the last time we're going to have to talk about potential limitations and risks. The biggest takeaway for this one is that those with an in-plan Roth conversion, you're still going to have to take RMDs. Again, all of the converted amount is added to your income in the year that you do the conversion, and the investment options or fees might be higher than if you were to do a Roth IRA conversion and move it to a outside plan. So as you've probably realized by this point, the decision of what to do with the money you've accumulated in your retirement plan is a lot more complicated than a lot of people realize. Your retirement plan assets likely represent years and possibly a lifetime's worth of savings. Now is the time to protect and preserve those hard-earned assets, and that starts with making the right rollover decision. Few people are aware of the potential options, and even fewer are aware of all the key issues surrounding those options, so you're already ahead of the game. Hopefully, we've answered some of the questions for you today about your options and the nuances surrounding them, but chances are you still have other questions, and that's okay. We're here to help. If you're looking to retire or change jobs, just schedule a financial check-in with your advisor here at FIT, and we can help you evaluate your options. While most of the options are available to everyone, not all of them should be considered for every individual. It's very specific to you and your situation. We're here to help answer your important questions, evaluate your rollover options, and design a strategy that's best for you and your family. We're living in a very strange and uncertain time, so having a plan can give peace of mind and help prepare for the unexpected. As usual, please like and follow us on Facebook. You can visit our website to keep up to date with our latest webinars and seminars. We're trying to do these webinars once a week going forward to make sure we're giving you guys the best information that we can. And we'd like to thank you for joining us today, and hopefully we'll chat with you soon. If you can, please take a couple of minutes when you get off of the webinar. A survey is going to pop up, and just ask a few questions, whether you do want to schedule a meeting. If so, Carrie will reach out to help you get scheduled. Also, there is a few questions surrounding what type of topics you guys would like to see in the future, so we can make sure that we're presenting things that are relevant for you.